Aloha class is a video for in-class assignment number 18, and we are moving into learning objective 8-3, compute and report interest on notes receivable. A company reports notes receivable if it uses a promissory note to document the rights to collect money from another party. So instead of a notes payable, which we have done in a previous class, we're going to be lending money and having other people sign a promissory note. We'll give away our cash and we'll debit our notes receivable. And then we are expecting interest back. So with any promissory note, there's an obligation for interest to come back to us. Generally, interest-free notes receivable charge interest from the day they are created to the day they are due, so the maturity date. And the way we calculate interest from your reading assignment, principal multiplied by interest rate multiplied by time. And so, for example, if we started in January and went all the way to December 31st, that'd be 12 out of 12 months. And so the full 6% on $100,000 notes receivable would earn us. So we would have an interest receivable, or we'd receive the cash, and we are creating, or we're making interest revenue. And that we would earn the full 6,000 if we were the one issuing the promissory note, and we had that notes receivable outstanding. And then if it was 10 out of 12 months, we wouldn't get the full 6,000. We'd only get 10 out of the 12 months of interest, and that would only be 5,000. And then from November 1st to December 31st, only 2 out of the 12 months. So be careful with your timelines, because it could be 2 months, it could be 12, it could be 6 months, depending on when we issued the promissory note to when it matures. And then we do have an adjusting journal entry, so we can hit the end of the year and we need to make sure we've accrued interest, which accrued could either be positive, like we have an asset coming, accrued an asset, or accrued could also be we have a liability like incurred. But accrued can mean a positive thing, which is good, that we've earned revenue, and we need to accrue our interest that we've earned at the end of a date or end of a period, because we're closing our books. And then at the end, we are actually going to receive the interest as well as the notes receivable back from whoever we've loaned it to, excuse me. So this is our basic entry where we loan out the cash. Our cash is going down and our asset of notes receivable goes up. And so we debit an asset and we credit an asset, and the debit of an asset is notes receivable and the credit of an asset is cash. So you can see that right there. And then we can look at the time period that we're earning interest. So how many months? This one is 2 months. And what is the principal and the interest rate? And we have to account for time. So we have this interest receivable. This is accruing interest that we've earned, and interest revenue. So this would be plus R plus SE. Interest receivable. Receivable would be an asset. And then finally, we can do the end at the maturity where we're actually going to receive the cash and get rid of the receivable. So we already knew at the end of the year that we had that receivable that had been accrued. We're going to credit the receivable and actually realize the cash and earn any additional revenue that we haven't accounted for. And so this is the cash, all of the cash coming in and realized for interest, get rid of the receivable, and then finally earn the rest of the revenue. So we're going to do some of those entries in this assignment. I think this one's more simple. I don't know if we have, let's see how long we have in our time frame when we're going to look at interest that's been accrued on the notes. So we loaned $50,000 to cashiers of the company. So you can loan whatever money that you want to whoever you want. And these are 8% notes. So we're acting like a bank and we're going to have a notes receivable. 8% is key. It's 1 year. And we have $50,000 that was loaned to cashiers. So we're going to debit our notes receivable plus asset for $50,000 and loan out that money to cashiers. Cash minus asset, $50,000. And then we're going to accrue interest on the note. And when I look at January, all of February, March, April, May, June, that would be 6 months that we've earned interest. So that could be like a year end that we need to just accrue, or maybe the accountant comes in and needs to make sure we're up to date. So not received, it just says accrued. So that accrued interest would be our interest receivable plus asset. And then we are earning revenue. So we want to lend out money because we want to have that 8% interest rate coming in. And so we're going to have interest revenue, which is plus R plus SE. And then we need to figure out how much is this going to be accruing interest. So 50,000 is the principal multiplied by the interest rate, which is 0.08, because it said 8% notes over here. And then we're going to do time. And so how many months have they been earning interest from January? We said, all right, we counted 6 months out of 12, 6 out of 12 months. That's 50% or 0.5, if that helps you with your calculator. I'm going to pull up an Excel so we can see it. So 50,000 multiplied by 8% multiplied by 6 out of 12 months for our time. And 50,000 multiplied by 8%, and then 6 out of 12 months. And so it looks like 2,000 interest over here. 2,000 interest is what's going to be accrued. And remember, that was our calculation over there. And then we need to make the entry for received interest on the note. No interest has been recorded, and received principal on the note. So we set up this interest receivable, and now we're going to receive it or realize it in cash. And no interest has been recorded, so no adjusting entries throughout the time period. So now we're at December 31st. 6 more months have passed, and I want to get rid of this interest receivable, and I'm going to earn all right. So 6 more months I'm going to earn of revenue, and I'm going to receive all the cash. So I could calculate what is all the cash that they owe me for the whole year. 50,000 multiplied by 0.08 multiplied by 12 out of 12. And that would just be, if this is 6 months, it would be double that. So it would be 4,000. But just to make sure, you might as well calculate. I'm going to pull in my Excel. 50,000 multiplied by 0.08 multiplied by 12 out of 12, which would just be 1. Or you could just take out the 12 out of 12, because that would just be 1. Or you could just put 1. 12 out of 12 months. So we're going to earn 4,000 over the year. Remember, we've already recognized part of the revenue, but 4,000 in cash will be realized. So our asset goes up of 4,000. We're going to get rid of the receivable because we're going to realize all of the cash. That's what we really want. We don't want the promise for cash. We actually want to receive the cash. Interest receivable will now be zeroed out minus asset for 2,000. And then finally, we need to earn the rest of the revenue, right, for the rest of the 6 months. So that would just be the leftover there. And of course, you can interchange the interest receivable and the interest revenue. There's no specific order as long as they're both credits. So earn the rest of the 6 months that we haven't recognized in revenue. And then finally, we receive the principal on the notes. So we just get this 50,000 principal back. And so we're just going to reverse that, receiving the cash back plus asset, and the notes receivable will go down minus asset for 50,000. And then I'll continue this in-class assignment on the next video.